Hey, how you doing, everyone? Eric Darnley Small here, and the video you're about to watch was recorded yesterday before the Fed decided to cut interest rates by 50 basis points. And I just want to play a little bit of video on the aftermath was recorded yesterday, right after the Fed decided to do that cut. I'm recording this today on the 19th so that I can put it in some context what happened. I briefly talk about the interest rates. I mentioned it in the video that comes in today's episode, but I just wanted to add that since this whole video is about the economy and what I believe is happening and what we should look out for, what we should not miss in the economy going forward. So take a look at this video and then today's episode starts.
The Federal Reserve has been climbing a mountain to combat stubborn inflation, so fast that it raised its benchmark interest rate 11 times in 16 months, then left it unchanged for more than a year. But now,
the committee decided to lower the target range for the federal funds rate by a half percentage point.
Now is a make or break moment for the Fed.
while prices have cooled, an uptick in unemployment has reignited warnings of
a recession.
And so the question now is, can they stick the landing? The economy's done pretty well, and inflation's come down anyway.
The U.S. economy added 142,000 jobs in August, a slight rebound from the summer's slump in hiring, but a notable decline from a year ago.
The cooling in labor market conditions is unmistakable.
Earlier this year, you heard a lot of people saying, look, this economy's doing all right. The economy's adding jobs, the unemployment rate is at a historically low level. Why rush this?
The Fed announced at its September meeting that it would cut rates by 50 basis points, starting on a faster path down the mountain.
We thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision.
A 50 basis point interest rate cut signals more urgency here. They raised rates a lot, and they raised rates in large increments on the way up. And so now that inflation seems like it's under control, but there are more risks of a bigger slowdown in the job market than they want, they're going to take back some of those interest rate cuts more rapidly too.
Welcome to today's show. I am your host, Eric Darnley Small. If you like what you see on today's show, please consider liking and subscribing. It helps notify you when new content is available. It also helps notify me as to what is going on with this channel. And as you know, if you've been here before, you'll know that I'm going to read from stories and from articles. As you know, I like to show my homework. So you can go to my Mastodon at mastodon.vtip.me/what you missed to see links to the actual article and download the articles from their source. I encourage you to do that so that you can make up your own minds about everything I talk about here, and you can also reach out to the show and to me about what it is you see here if you have questions, comments, etc. Speaking of which, and going off of my first point about liking, subscribing, and notifying, I am noticing that I am getting responses now, and I am getting a lot of views. Thank you very much for your views. Thank you very much for your opinions. And some of you out there, I know I've been having a back and forth with over that. And that's going to be the focus of today's show. But I just wanted to note, this is my, this is the channel's, behind the scenes. And this particular article on the recession apparently has gotten a great deal of information. The most number of views I have ever seen on any of my channels, which means I now have an idea of who's watching the channel and what your interests are. And your interests are in alignment with my interests, because I am absolutely and completely fascinated and interested in talking about the economy and what's going on in the economy. And anyone who has been to this channel knows that I have focused a great deal, few episodes, number of episodes actually, on not only the economy, but specifically what I think is some of the weakest parts of the economy stemming out of COVID. and that is commercial real estate and visa and as related banking industry. And I'm going to go into the truth, and I'm going to title this YouTube "The Truth on What Is Going On with the Commercial Banking," because I think that there's a lot out there, and we know the Fed is expected to cut interest rates. We expect that to spur real estate, residential real estate, but coming out of COVID, commercial real estate, particularly here in New York, has been devastated because companies have decided to have their employees work from home. That way they could get out of leases during COVID because of the pandemic and because of new technology and all of that. They have decided to save money on cutting and getting out of leases. So that has an effect downstream. And I want to talk about that because I think for the average everyday one of us, we're not going to see the effects of this for some time, because commercial real estate doesn't affect the average everyday person, particularly if you still have a job and you're working from home. You may actually prefer to work from home. Although some companies are giving that perk up, Amazon namely being one of them. Their CEO has recently announced people back to work 5 days a week. But there is an effect, a cascade effect that I've talked about. I haven't talked about, but I will get back to international real estate, commercial real estate, which is a total disaster. I've talked previously about China and how its real estate industry is going bust, and that is going to have a downwind effect on the banking industry there. But today's video, let me talk about it. Let me get into it, and it is the truth, the truth on the economy banking edition. Is commercial real estate and regional banking a problem? We know this was a problem last year, and I'm going to go into that in a minute. But is the U.S. economy in crisis? So I've had a back and forth with a couple of people, one in particular, over this very issue about the economy and whether it's healthy or not. I believe the economy is a moving target, and I think that there are some things that are good that are going on and some things to watch out for. And don't take my word from it, but Janet Yellen has said the same thing. So, but let me go over my thoughts as I have articulated it, I think, before. I've done several videos on business and the economy. I've seen many comments from viewers reiterating, and I want to reiterate my thoughts here. The U.S. and Biden, along with the Fed, have done a remarkable job creating what appears to be a quote-unquote soft landing for the economy. Economists have stated high inflation was not due entirely to wage increases and pandemic spending, as other economists have claimed, but on supply chain issues after COVID. I was going to originally put up a video from a guy from AEI who talked about in 2022, and I may link to that video, about how it's highly likely we're going to go into a recession. The Fed acted too slow. There is no way you're going to have a soft landing because of the slowness of the Fed. All of this stuff that is still percolating around. People are waiting for the economy to go belly up. But and you know, I would say we're not out of the woods yet. I think there's a lot. The election and through to the end of this year into next year is going to be very interesting, particularly as the Fed starts cutting rates again. But the idea that we were going to have a this brutal recession because of wage and brutal inflation because of wage increases and because of COVID spending turns out to have not happened. Looks like Keynesian economics actually worked. And this proved increasing wages does not cause inflation. The entire world went into recession. The U.S. did not, even with wage growth and high spending. By the way, part of that high spending was Donald Trump and the Republican Party, who rightly signed through a bill that would, because the country had shut down, that would allow people to continue getting checks and not go into bankruptcy. The Fed, as I indicated, is expected to cut rates 0.25%, according to CNBC, which will provide some relief. Given all of that, the economy is not doing fine. There are real problems unresolved. Commercial real estate is still a basket case. This comes out of COVID. More people are working from home and not going into the office. Home delivery companies like Uber Eats, Grubhub are on the rise. But in places like New York, commercial real estate will have an effect on mom and pop shops that used to feed employees. As commercial real estate and small businesses go down, so will banks, which had a real crisis last year. So this is my thesis. This is my theory, is that the issue with commercial real estate has, as I've said, a cascade effect, and that as people stop going into work, particularly if you ever go down to downtown Manhattan, Wall Street, one of the things you'll notice is the number of restaurants and shops. I'm not talking about big time fancy restaurants. I'm talking about little eateries. You've got guys in carts and whatnot, and they're there to feed the people who are going to work in those areas. There's also little bodegas and stuff like that, smaller shops like that around. There are gyms around in those areas, etc. As people stop going to work, and I happen to be in downtown Manhattan earlier this year in the summer, and I went into one of these huge buildings right there off of Wall Street, and there were only 3 offices out of, or maybe 4 out of, let's say 10 or 15 that were occupied. The rest of it was vacant. And when you go downtown and you see the number of businesses around, all of those businesses are going to begin to feel the effects of not having that foot traffic, not having those folks there. Now, you could say, well, they'll get Uber Eats and they'll get Grubhub and whatnot. I doubt it. I'm very skeptical on that. So not only are you going to have commercial real estates where people are going to start falling out of their leases or not going to renew their leases, etc., or businesses may even go under due to whatever results of COVID. So that means those leases are going to go under. You're going to have buildings having to sell at record low prices. We've already seen some of that. And in addition, those mom and pop shops are going to begin to feel the effects. And worst case scenario, they're going to start going out of business. So the cascade effect is going to be very powerful going forward. But let me move on. And I want to sort of update us and level set to where we're at. And the Fed, believe it or not, has a podcast called Fed Podcast. Link in the Mastodon, which I'll provide. And this particular episode of the Fed is called "The Risk of Banking." And I want to read from the transcripts of this because this is the biggest update that I can get on what the government sees right now as to the issue with commercial banking, with commercial real estate and regional banks. And I don't know where the actual audio is for this, and I didn't hunt around. I think you can go to Apple Podcasts. I didn't hunt around because I wanted to get specifically to where I'm at. So I'm just going to read this transcript. It's not very long. I just want to read this so that you can get a sense of what the Fed is thinking about and is reporting on what's going on. So let me get to that right now. So the host here is Brian Sullivan, and he is with the Federal Deposit Insurance Corporation. The FDIC's 2024 risk review is out. This is the host of the program saying this. So I'm Brian Sullivan with the Federal Deposit Insurance Corporation. The FDIC's 2024 risk review is out. It's an annual summary of risks in the banking system focused on community banks. Kathy Calliser, an senior economist from the FDIC who is on this podcast, she says, quote, "The report begins with an overview of economic and financial conditions last year and how banks performed under those conditions. Then the report discusses risks that banks faced during 2023 and continue to face in 2024. Risks are discussed across 5 broad categories: market risk, credit risk, operational risk, crypto asset risk, and climate-related financial risk. Monitoring these risks is among the top FDIC top priorities." Now, Brian asks Kathy, what does this year's risk review tell us about the conditions of the U.S. economy, the financial markets out there, and the banking industry? John Anderlink, who is another economist also on the podcast, says, quote, going back to the spring of last year, when those three banks failed, things didn't look great for the banking industry. Now, those three banks they're referring to is Silicon Valley Bank, Signature Bank, and Silvergate Bank. Both were taken over by the Fed because they were on a risk for collapse due to a run on the banks. So, continuing on, this is again John Anderlink, who's the economist. He's representing the Fed along with Kathy in this. And he goes, quote, but banks ended up showing a lot of resilience as the year progressed. The banking industry earnings remained high in 2023 as higher net interest income more than offset higher provisioning expenses. In addition, asset quality for the industry and community banks remained favorable and capital levels increased in 2023. I think it's safe to say the banks benefited from the strong economy we ended up experiencing last year. Inflation moderated, the labor market remained strong, and consumer spending was pretty robust. And importantly, we avoided a recession or anything really even close to one. Brian says, Kathy, the bank failures of last year really exposed the capacity of banks to stay ahead of very sudden runs on deposits. Are we seeing the buildup of uninsured deposits continue in the banking system, and does that give you cause for concern? The overall banking industry's liquidity position, however, stabilized in the fourth quarter of 2023. So to answer your question, I am now able to sleep better at night. This is Kathy saying this. But we're watching community banks. Community banks have increased their reliance on wholesale funding to support continued loan growth, which has resulted in weakened liquidity positions at the end of the year. These levels were the lowest since 2009, and we continue to monitor this situation closely. Brian, when it comes to all the loans that banks are making, which loan categories are you looking closely at regarding the risks that they present to the industry? Kathy says, in the risk review, we discuss lending types by types of loans, and at the very top of the list is commercial real estate lending. So, what is all that saying? Basically, that's saying that we dodged a bullet last year. The banking industry really there was an opportunity, there was a chance for the banking industry to really have a hard time last year. 3 banks failed. The FDIC was ready, willing, and able to get in there and to save those banks. However, there are things that are still going on. Commercial real estate is still something that is very concerning, as Kathy says. In the risk review, we discuss lending types by types of loans, and at the very top of the list is commercial real estate lending. So commercial real estate lending is at the very top of the list that the FDIC is looking at with banks. It is still a huge problem for them. And what that means for us is a number of things, is that, we're not out of the woods yet in this economy. Yes, things are getting better. Yes, things are healing. Yes, the Biden administration and Kamala Harris hopefully will continue to be vigilant and to work really strong. But there are a number of things that are going on here that are under the surface that people don't think about and don't realize that are in play here that could upend everything. Number one, the reason why the FDIC was able to prevent a contagion, prevent more banks from going under, and create stability and confidence. Confidence is huge with the stock market and with the economy. It almost runs on confidence. And the reason why we had confidence is because of Dodd-Frank. Dodd-Frank law created a number of very important safeguards. Banks couldn't run up massive debts without showing that it had the money to pay it, and other protections in there. But that part is significant. I'm going to go into my final takeaways here. One is, as I stated earlier, commercial real estate is still a problem. COVID has changed the game for business. Banks are on sound footing thanks to Dodd-Frank and capital requirements. Banks are stable, but the economy is still fragile. Banks have operational risks, and I've covered that in previous videos. The infrastructure is old, and I'm going to put up on this page, on this video right now, you'll see at the top a link to the video that I did. And one of the things that came out of a recent report, when I say infrastructure, I am talking about not the loans themselves, but the structure, the way in which the business is run. The technology, the computers, how it's being run is old and hasn't been upgraded. And that came out in a report fairly recently to Congress, which was concerning. That is something to look out. The reports are the regulators are working with the Fed to weaken capital requirements under Dodd-Frank. So I put out a video not that long ago. Elizabeth Warren's face is on the thumbnail. And Elizabeth Warren goes on CNBC and has been calling out Fed Chair Powell, who apparently has been working with, according to her, Jamie Dimon, who is the head of JP Morgan Chase, about trying to weaken these capital requirements, right? So what happens when you have a crisis? The crisis is stopped. And by crisis, I'm talking about the 08-09 Great Recession. Banks went down like crazy because of shenanigans going on in the banking industry. What came out of that is Dodd-Frank. Dodd-Frank created capital requirements as mandatory. Once you're far enough away from the crisis, the tendency is for people to go back to the irresponsible behavior and to begin to lobby and begin to use their power, businesses' power, their money, to get these regulations dismantled. For years, how many years was it that we had Glass-Steagall, which was around that separated commercial banking from regular mom and pop banking? Bill Clinton did that, repealed that law. And what we had 10 years later is the 08-09 crash on Wall Street. And many people were pointing back to Glass-Steagall. Thank you, Bill Clinton, Democratic Party. So, don't get the sense that I'm thinking that, that this is all on one side, the GOP. Both sides are to blame here because of the influence of the banking industry in this, in politics. And just as a note, Joe Biden used to be called the senator from MBNA, the bank, because he was so tied to the banking industry. That's not the case today, but I mean, that was his reputation. So I don't want people to think that this is a partisan hit. However, Donald Trump went in at the request of banks and undid the capital requirements, or lowered the capital requirements for regional banks. And within years after that, these regional banks went under and didn't have the money. Silicon Valley Bank did not have the money because it had taken that money and invested it. And when there was a run, it didn't have the capital, the liquidity, as they call it, to fund the withdrawals. And the bank, collapsed under that. Well, it didn't collapse because the FDIC came in and rescued it. But it created a panic. And when you have a panic, as I said earlier, confidence and a sense of reassurance is what fuels the Wall Street. And when you have a panic, it can become a contagion. And when you have people panicking about banks, not only do they start taking money out of their regional banks and their local bank, but they start taking it out of all their banks. So you start seeing even perfectly solid, perfectly collateralized banks beginning to see runs. Lastly, let me state that. So this is when I talk about why the economy is still not fine. It's because there's pressure being put on the Fed to weaken capital requirements to all banks by Jamie Dimon. And Elizabeth Warren, thank goodness, is doing great work by calling this out. She sent a letter to Fed Powell to answer to this. What is he doing? If commercial real estate doesn't come back, what will happen to businesses, restaurants, stores that use to service employees? I mentioned that earlier. That could be a possible issue. It could be a possible quote unquote crisis in the making. Bank performance was due to spending, but reporting is that consumer debt is increasing. There is a fairly decent chance, and I just saw this recently, that this winter, this Christmas, we could have a somewhat of a weak Christmas. We could have weak spending because we're beginning to see the American people are beginning to get a lot of debt, particularly credit card debt, is going up and up and up. Very concerning. If spending slows, the whole thing could come tumbling down. So bottom line is, my thoughts on this is that the economy is not 100% bulletproof back. It is doing okay. It has come out of COVID thanks to Biden and the Fed Chair Powell. There's been pain, but there has been an incredible resilience that we haven't gone into a recession. Inflation is coming down. People are getting confident again. However, there are a lot of things that are happening underground, underneath the surface, that is very concerning, and we should keep our eye on it. And I will keep looking at this and reporting on this because I see you guys are interested as well, and I'm really happy about that. Thank you for watching today's episode. You will see me on the next episode very soon. Thank you so much. Take care, guys. Hey there, fantastic viewers. Eric Darnley Small here, and I hope you're loving today's episode of What You Missed. You've reached the end of today's show, but don't worry. There's more show coming up. If you're watching this on YouTube, please click the bell so that you'll be notified when more content is available. You can also help the channel by clicking the like and subscribe buttons. It helps the YouTube algorithm find new viewers so that I can keep bringing you all this incredible content you enjoy. But wait, there are more ways to support the show. You can make a contribution through the show's PayPal, which goes a long way in helping produce even better content for you. And consider becoming a part of our growing community by joining our Mastodon site at mastodon.vtip.me/@whatyoumissed for more engaging discussions and exclusive updates. And here's something you won't want to miss. Mark your calendars for our live show streaming on YouTube and stream.vtip.me Monday mornings, 10:30 a.m. Eastern Standard Time. Your support means the world to me, and together we're making What You Missed the best it can be. Thanks for being a part of my journey.